Hello and welcome to this special series, Navigating Through Uncertainty. It has not been the best starts for 2019 for global equity markets. Trade tensions, concerns over sustainability of global growth are now starting to weigh in on investor sentiment across the globe. In an environment like this, Allianz global investors expect the environment of low returns and high volatility to continue going forward. Let's discuss all of this with Lucy MacDonald. She's the CIO of Global Equities at Allianz Global Investors, joins us right now on the platform. Lucy, so good having you. Thanks so much for taking the time out. That's my principal question to you. What's the outlook for 2019? Because January provided a bit of relief to what was arguably a terrible month of December for the US equity markets and other equity markets by and large. Is that the peak of optimism for equity markets in the near term?
Well, we're expecting the pretty moderate returns and higher volatility to continue. That's what our expectation was for last year, and that's continuing into this year. And the big drivers of that are the liquidity environment, so that the really long-term shift from the quantitative easing to the quantitative tightening, accompanied by gently rising interest rates. Then the slowdown in growth that we've been seeing really around the world, and particularly that's going to be seen in the corporate earnings this year because of a very strong year for earnings in the US last year, which were driven by tax reform. And then the starting point is still quite high valuations for equity markets. Now, they've derated slightly towards the end of last year, but still in historic terms, certainly price to sales looks on the high side. So all of that added together suggests a sort of a long-term, just sideways, quite volatile market. And throw into that picture the trade tensions that we've really had building up over the last year and that are still not resolved and are quite long-term in nature. And then an additional, the reform that's happening in China, which is providing quite a lot of volatility as they try to reform and then keep the economy going at the same time, which is leading to quite a lot of stop-start.
Lucy, okay, so let's try and tackle some of these issues one by one. What did you make of the pullback in the Fed commentary, as also the expectations that the market derives out of it? For some people, and the people who are slightly more sanguine about the prospects seem to believe that here's the largest central banker showing flexibility over a short span of time in order to support the markets both in sentiment and in action. And if the Fed has done that, others might follow suit too, and therefore this whole belief of central banks pulling away and the markets will be left to their own might not quite hold true. And even if the markets were to correct, this would mean that there will be a very soft slide as opposed to a hard thud that we may feel in the equity markets across the world. Is that a correct assessment, or would you differ?
No, I think that's correct, and that's certainly one of the reasons why the markets have recovered in January. One has been the Fed being more dovish, and the other has been rising optimism that some agreement would be made on US-China trade. So both of those are clearly, have been big headwinds towards the second half of last year. And so if they're in the short term, there is better sentiment towards it, it's absolutely logical that the market should recover. However, we are still in an environment where you've got a long-term shift in that liquidity environment. So in the short term, yes, there may be more optimism, but we've still got some way to go to shift from the quantitative easing that we've had. And we are against a backdrop of very high indebtedness all around the world. So the level of debt in the US and elsewhere is higher relative to GDP than it was during the financial crisis. So that debt provides a lot of fragility to the backdrop. So you can see some sentiment sort of coming and going, but it doesn't change that overall backdrop, which is quite fragile, as I say.
So is the world then underestimating the extent of fall that could happen as well, and the swiftness with which it could happen, Lucy? Just throwing out the counter argument there. You yourself mentioned about how the levels of debt are at unprecedented levels, if I can use that term. The earnings growth is definitely going to slow down. In the US case as well, the high base of 2018 will come to haunt the companies. I was reading a Bloomberg article which said that for the first quarter, the profit growth estimates are negative for the first time in a number of years. So growth will slow down. There are trade tensions. Oil is a commodity that could flare up in either direction, and the high level of indebtedness. Are we missing something in the optimism that comes to investors as a result of coordinated central bank action?
Yes, I think just remembering that level of debt in the backdrop, that's the context against which all of these markets are operating, and I think that can be forgotten from time to time, but it does mean that the central banks are operating in a very difficult environment. These are not normal cycles. We are coming through a huge financial experiment with quantitative easing, which was not clear what the impact was going to be at the beginning. It was hoped that it would do what it did, and it was very successful in raising asset prices. But as it starts to turn, the impact in the other direction and the scale of that impact is less than clear. And so the central bankers are treading very, very carefully. And so the impact that was seen towards the end of last year, some of that was to do with the quantitative tightening and high interest rates, some of it was to do with the trade wars, but it certainly was severe enough to cause a change of direction with the Fed.
Okay. The other bit would be what is the big worry now? Obviously, everybody right now talks about trade tensions. I think the whole conversation between Donald Trump and Kim Jong-un has receded to the backdrop completely. Oil has ceased to be a worry, or has at least ceased to be the chatter of daily morning meets as well. Do you think that they are less and less a worry for the equity markets, or is it unpredictable what either of these two elements could do?
I think North Korea is more of a sort of existential, sort of global, issue rather than specifically for markets. So that's always going to be there. For oil, it is generally a source of volatility in one direction or another, and essentially impossible to predict. At the moment, it's had a strong month. It's coming off again. It is definitely continually a source of volatility, but it's not the most important thing. Neither of those things are most important. The big drivers of equity markets are overall liquidity and growth, and those are the things which will make the difference. And trade is important in that it affects growth, and the trade tensions and the tariffs that we've seen so far have had an impact both in Chinese growth but also on costs in the US. And we've seen that coming through the earnings season now, although it's been relatively quiet because I think a lot of the US companies don't want to talk too much about it because it's clearly political, but they have seen upward pressure on costs because of tariffs.
Okay, interesting. I just want to slip in an emerging market related question out here, Lucy. All through 2018, the conversation that dominated our newsrooms was the Fed and the rate hike cycle that it seemed to be on, at least at that point of time. It was a near certainty. And if it were to continue in 2019, at some point of time, I remember people saying that people are underestimating the extent to which the Fed would raise. The Fed itself is underestimating. Now that doesn't seem to be the case, and the Fed is not going to raise rates. For all you know, it might even cut rates in the second half of 2019. What does that do to that liquidity picture for emerging markets? Because you alluded to how liquidity is the single biggest factor. How does liquidity work out for emerging markets at a point of time when the balance sheet contraction as well as the rate hikes or the status quo on rates are both question marks?
Well, I think you explained it very well. The liquidity environment is very important for all markets, but the picture in emerging markets is affected by the dollar by US interest rates and energy prices in particular, and then trade. So those are the things which were concerning investors in emerging markets last year and now have turned in this year. And so the dollar weakening slightly, the US interest rates pausing, oil price a little bit weaker second half of last year, and any sign of concession on trade. Now, all of those things directly benefit emerging markets, and logically enough, emerging markets have started the year better. So it all is working in textbook fashion.
But I understand you do a lot of less work with emerging markets and more work with global markets, and therefore I'm intrigued, or rather I'm wanting to ask you about your base thesis, wherein you mentioned that there is a higher probability of an environment of lower returns with higher volatility. How do large asset managers like you work in such a scenario, wherein volatility seems to be a certainty, returns don't?
Well, we focus on quality. We always want to invest in stocks which have got good balance sheets, which have got a history of good capital management, and preferably good governance and ESG. So that's something we're always looking for. In the environment that we are in, where returns are harder to come by and volatility is higher, that quality focus is even more important. So I think we've already seen that particular, the style of quality, beginning to outperform last year, and I think that will continue as we go through this more uncertain period. The other factor we're really focusing on, which is a very long-term one, is technology and the impact of digitalization across all sectors. Technology is no longer just one sector of the stock market. It is through all sectors, and the companies which are able to deal with that impact, whether it's a retailer, whether it's a consumer branded goods company, whether it's an industrial company, those that are able to harness technology to either increase sales or reduce costs, improve their productivity, and fight off potential new competitors, are those which we think are going to be the good investments in the long term. So that's a big focus, and I say that really is on top of a long structural trend which is going alongside all of these other macro issues that we've been talking about. So it's always something that we're focusing on. At the moment, I think there's a stark differentiation in stock markets between the winners with technology and the losers. We can see that throughout all industries. That's going to continue to be a factor. So we want to invest in those winners. We want to be the ones that are on the right side of history. And we want to have, as I say, at the same time, we want decent, quality businesses as well that have got some duration and sustainability of growth to them.
The problem with that, Lucy, though, is that a lot of smart investors like yourselves would be wanting to do that, and therefore none of these names which fulfill all of those criteria would be available at a price which will necessarily give the confidence of returns. How do you balance that out?
Well, I think you'll find in December, many of them were selling at a bit more of a discount. And so that's what the volatility can bring you. It can bring you some opportunities. So what we have is a list of companies, some we're invested in and others that we are interested in investing in, but the valuation's not right. And when you get a situation like we had in December, where there's quite a lot of fear in the markets, some quite indiscriminate selling, then that gives you the opportunity to add some of these names and to add them into your portfolio. So that's what we will be doing in more volatile times, and that's what active investment should be. It doesn't mean that you are continually trading. It means you're taking good conviction positions, but it does give you some more opportunities at the margin to add into that volatility.
Interesting. Yeah, well, okay, I take on board the point. December did provide that opportunity for a lot of people, I'm sure. The other point that you're making is about how business models and select business models will likely do well. Are we to assume that because of the continuous focus towards select business models and quality and the balance sheet strength, that the market will continue to become even more narrower, in that people will be willing to pay a small premium over and above the existing premiums because there is certainty of performance and returns and likely returns to those companies compared to others? Because frankly, everybody talks about FANG and how narrow the rally in US has been, I don't think India is too different, Lucy. We've had a set of 10, 15 stocks which are helping the index go up. The wider portfolios at the broader end of the spectrum are profusely bleeding.
Yeah, I think there will be potential for narrow leadership as we go through this time. But in fact, the leadership has been broader over the last few years. Indices have been driven by technology in particular, but there's also been areas of consumer and healthcare and industrials which have done well too. So I think, as we go through the next few years, that balance sheet differentiation will mean, probably a little bit narrower on that basis. Investors will be more choosy about the quality of the companies that they're investing in. But there's still plenty of scope. I mean, for a global investor, there are thousands of companies, out there for us to choose from, and new ones sort of growing up all the time. So there's plenty of opportunity, and for concentrated sort of high conviction portfolios that we run, there's no shortage of decent companies. I think the issue has been over the last few years the fact of lack of valuation opportunity. But as I say, we're getting some more interesting valuations appearing now.
Okay, so what's the big call for 2019 or maybe even early 2020? Equities, debt, or is it some other asset class? Gold has been, literally setting the stage for some more gains, trading at fresh highs, at least in the Indian context as well, converted into India. I mean, what's the big call on which asset class does well?
Well, I do equities, so I'm biased in that, and I wouldn't claim to be able to forecast what drives gold. So equities for me, it still makes sense to be taking some risk. With equities, you're getting a dividend yield and growth, as well as the ability to have capital growth over the long term. And you have a huge, diverse pool of companies globally, which gives you plenty of ability to diversify your risk at the same time. So for me, it's always going to be equities.
Allianz look at India, Lucy.
Yes, and it does offer interesting top-line growth. There's no doubt that when you look, around the world and see where there is, growth opportunities in the medium term, India really stands out. And the reform that's been going through is clearly positive as far as global investors are concerned. I think, where the hesitation is for a global investor is really understanding, on the ground what's happening, and you can see this for global investors, but also for companies who are operating in India, and we have seen quite a lot of not necessarily disasters, but surprises for companies that operate in India, and whether that's sort of Nestle, Vodafone, Adidas, and more recently Amazon, who have had surprises in their operations on the ground. So I think it's, we want to really understand what it is that we're investing in. The big risk when you're investing is not understanding what it is that you're investing in. So building up your understanding before you invest is the most important thing, for us, and being able to monitor it as you go along. So understanding on the ground.
Are you saying that incidents such as that would have the potential or have already created some bit of aversion in the minds of global investors who may not be completely exposed to India directly, but might be doing it only through an indirect route?
Yes, I think it's not aversion. I think it's caution, and very sensible caution. When you invest, as I said, you need to understand as much as possible about the environment in which the companies are operating, and that for a global investor is the first thing that you need to be able to think of. And with companies that have had these experiences, they are clearly going to exhibit caution in the way that they invest.
Okay, my final question to you, Lucy. When you decide to go out and invest money into large emerging markets, this comes from my conversations with a lot of other global investors. India thus far finds, unless there are select few who actually look at India and have India-dedicated teams, the monies that are being diverted or rather invested into India are done on a passive basis. Do you think at some point of time, instead of being clubbed in the EM bucket or the MSCI bucket, India, which will be maybe a $3 trillion, $4 trillion economy in due course in the next 3, 4, 5 years, would find large global investors making India-dedicated bets as opposed to clubbing it with the other markets?
Oh yes, I think so. I think the whole sort of concept of emerging markets is slightly old-fashioned now as well. I mean, China itself is we think of as a separate asset class. India is going to be of a similar scale, so I think that's exactly right. These countries are different to each other, and the opportunities and the companies are also different. And where we come from as equity investors is really from looking at the companies themselves. That's what we're looking for. We're looking for world-beating companies wherever they happen to be. And India certainly has the technology companies. It has healthcare and some consumer companies which have got the ability to grow. So that's what we're going to be looking for, rather than necessarily looking at a top-down allocation. But I think the whole real construct of emerging markets is more to do with indices than actually active investing.
Great. Lucy MacDonald, it's been a pleasure chatting with you today. Thank you so much for taking the time out and speaking with us. Have a great week ahead.
Pleasure. Thank you.
All right. Well, that's a very important market voice. Lucy MacDonald, the CIO of Global Equities at Allianz Global Investors. Viewers, thanks for tuning into this broadcast.